Well, hi, everybody. Welcome to the Buffett and Beyond Stock Analysis Video Podcast with your host, Dr. Joseph Belmonte, which is me, and Debbie with a Y. Hi, Debbie.
It's me. Hello.
And all these methodologies are based on the book Buffett and Beyond, second edition by Dr. Joseph Belmonte and published by Wiley Publishing. And remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. Now remember, folks, the clean surplus return on equity is both a comparable and a predictability model and is totally different than the traditional accounting return on equity, so don't get them mixed up. And you can equate the clean surplus return on equity as the interest rate you get from a bank. So this is common sense now. A bank account with a higher return or interest rate will earn you more money than an account earning a lower interest rate. So it just follows that portfolios made up of stocks with high clean surplus ROEs or return on equity will outperform other portfolios made up of stocks with lower return on equity or interest rates. So think of your bank account when we talk about these stocks. The good.
Stocks that should be in our portfolio.
The bad.
Stocks that should be in somebody else's portfolio.
And the ugly.
Oh, stocks that should be in nobody's portfolio.
Okay, let's get on with some stocks. You'll see exactly how this method works and how we here at Buffett and Beyond set the investing parameters so that you, all of you, can outperform most of the professional money managers out there in investment land. All right, this week we're going over the retail building supply industry, and Home Depot and Lowe's, of course, both come to mind. But we recorded this a little while ago, and we're repeating it, and then we're bringing an up-to-date on both stocks. And we want to show you something that's very, very interesting that is happening to both Lowe's and Home Depot, as we have numbers that just came out the other day for 2020. So we want to repeat what we've gone over with Home Depot and Lowe's and then bring it right up to date as of just a couple of days ago at the end of the podcast. All right, Debbie, let's go over Home Depot.
All right, first up is Home Depot, and they operate a chain of 2,286 retail building supply home improvement warehouse stores across the U.S. and in Canada and Mexico. They acquired Hughes Supply in 2006. The average store size is roughly 104,000 square feet.
That's a big store, folks, and
that's
you all know
That's
that.
the indoor. Then they've got the garden center at 24,000 square feet. And items stocked are about 35,000.
I can't even comprehend.
It's a lot to take in. Product lines include building materials, lumber, floor and wall coverings, plumbing, heating and electrical, paint and furniture, seasonal and specialty items, hardware and tools, and they have about 413,000 employees.
That's a lot of people, folks. Let's look at the numbers. The first thing we're going to look at is that clean surplus return on equity, and folks, that's pretty. All you got to do is look at that and say that's pretty. Now, the thing that's not so pretty is the retention rate. In other words, how much is the company making and how much of what it's making do they put back into the company? And we're looking about 53% for 2019. So it has gone past its serious growth stage, and now it's taking half the money it's making and paying out in the form of dividend. And the recent dividend, look up here, is 2.3%, actually 2.33% as of this morning. And I want to show you something. As soon as I see the retention rate right away, I think this is a stock that's probably not going to be in our growth portfolio, but maybe in our dividend growth and income portfolio. So I look at the dividend growth rate, and we're looking at an average of the past 5 years, 19.8%. And for 2019, this year, it's projected to be 11.7%. So that's pretty good, folks. And then we look at the net income growth, 5.9%. So it's slowing just like just about every other company for 2019. The growth is slowing. And looking at the revenue growth is also slowing. All right, so let's look and see how this company has performed over the past 1 year. And unfortunately, we are still in a corrective phase in the market, even though it's coming back nicely. But Home Depot has declined about 12%, while the market has declined about 7%. Now, this is the past 12 months. So it's underperformed the market by a little bit during this decline. And when we look at 5 years, we see it's up 120% while the market is up 40%. So folks, this is returning 3 times the market over the past 5 years. So that's looking pretty good. Let's look at our next stock. And Debbie, what about Lowe's?
That would be Lowe's, and they operate a chain of 2,133 hardware and home improvement superstores in the U.S., Canada, and Mexico. The average store size is about 101,000 square feet indoor and retail and 32,000 outdoor garden.
Gee,
it sounds a little bit bigger.
But it looks a little bit like Home Depot.
But it's all outside. Yeah, true. Product categories include appliances, lumber, plywood, paint, flooring, millwork, building supplies, seasonal living, fashion, plumbing, tools, hardware, lighting, and others. They have about 310,000 employees.
Yeah, so you can see it's a little bit about 25% smaller than Home Depot. But let's look at the numbers. Clean surplus return on equity. Again, very, very nice in here. And as you can see, it's been rising. So this is kind of neat. Now, looking at the retention rate, where Home Depot was putting 55 or 53% of the money it's making back into the company to grow, Lowe's is putting more of the money it's making back into the company to grow. And therefore, the dividend is lower than Home Depot's. And we see here the recent dividend of 1.7%, but as of this morning was exactly 2.01% as we speak. And then we look at the dividend growth, again, very, very nice. And what I forgot to tell you about Home Depot and the dividend growth and income portfolio is we want to see stocks with dividend growth rates of 7 to 8% or greater. But we also like to see a nice high dividend too. Now, looking at the net income growth here, we can see it's 18% for 2019, which is higher than Home Depot, and the revenue growth of 8% higher than Home Depot. So we're looking at Lowe's starting to catch up to Home Depot. Now let's look at the returns, and I'll show you exactly what I mean. And over the past 1 year, Lowe's is down 10%, while the market is down about 6 or 7%. So call it equal over the past 1 year. And then over the past 5 years, it's up 100%, while the market is up 40%. It's not up as high as Home Depot, and we'll see that in a chart where we compare these companies, but it's doing very, very well, folks. Very, very close, these two companies. Okay, now here we are with updated numbers for 2020, and we want to show you just a little bit change. And right here we're showing the market averages of the 2020 return on equity. That's a clean surplus return on equity. So the market averages of the S&P 500 and the Dow 30 are about 13.5%. 5-year net income growth about 11.6, and the 5-year revenue growth, that's the average over the past 5 years, of 6.3. So now let's look at Lowe's, and in the chart that we just showed you, Lowe's had a 19.9% ROE, and for 2020 it's expected to increase just a tad up to 20.2. But Home Depot fell a few tenths of a percentage point. So you can see what's going on, but those are very, very small increments here. So let's keep going. 5-year net income growth, they're pretty close in here, folks. They're about the same and much better than the average stock in the S&P 500. And 5-year revenue growth, Home Depot a little bit higher than Lowe's, and both of them higher than the average stock in the S&P 500. Now, we talked about the retention rate, and now the retention rate for Lowe's is 68%. Now, the retention rate is the percentage of the amount of money the company is making that it is putting back into the company in order to grow, and the rest of it goes for the dividend. And I remarked on Home Depot having a 41.6% retention rate, while Lowe's has a 68% retention rate. Now this is for 2020, and you can see Lowe's is really starting to pull away from Home Depot. So when the market looks at these retention rates, it can see that Lowe's is still growing and putting less money into the dividend than Home Depot. So Home Home Depot is retaining less, and the rest of it puts back into the dividend. So if you want the higher dividend, Home Depot is there. However, if you want a little bit more growth, then Lowe's is the one, at least with these numbers. We're going to see the chart in a second of year to date. Now, the notes, Lowe's is increasing its ROE, and this is just a tad, folks. It's almost not enough to make a decision out of, but the market loves an increasing ROE, and when it looks at the retention rate, it says Lowe's is more of a growth company than Home Depot is at this point, and Home Depot has just a slightly decreasing ROE. I almost shouldn't even be bringing this up, but it is increasing just a few tenths of a percent, not enough to make a big decision unless you compare with Lowe's that has an increasing ROE. So for growth, you're going to go toward Lowe's. The dividend, you're going to go toward Home Depot. And let us look at year to date. I usually don't show a year to date chart. I always show 1 year or 5 years. And we can see that Lowe's, the blue line, is up almost 18% for the year, while the market, this black line in here, or the black dots, I should say, is up about 13%. So Lowe's is really, really doing well relative to the market. And down here, this mustard-colored line is Home Depot, and Home Depot is underperforming the market averages, still up 12 or 13%. So folks, you can't squawk at that, but you can see the little increment change taking place. Lowe's looks by the numbers to be a better growth company than Home Depot, and in the past year that has proven so. And in other words, the returns of these two stocks are showing what the numbers are showing us. So again, Lowe's is more of a growth company than Home Depot, at least at this point in time. Folks, I've been going over Lowe's and Home Depot for almost 20 years now, and they keep changing spots, believe me. But right now, Lowe's is more of a growth company than Home Depot is. Home Depot has that higher dividend. So remember, folks, if you want to live on the beach like Jimmy Buffett, or just sit in that little rocking chair on your porch looking at the beach, then you've got to learn how to invest like Warren Buffett. Okay, folks, we had a good week this week. Next week will be better, and we'll see you next time.
Well, JB, I think we've just about covered all the questions sent in by our listeners out there in investment land. And remember, folks, we're here to answer your questions not only about individual stocks, but also about the stock market in general. So keep those questions coming, and who knows, we may even answer a question or two you didn't even know you had. And that's about it for today, JB.
Okay, folks, we had a great day today.
And tomorrow will be even better.
All right, bye, folks. We'll see you next time.
Bye, everyone.
And remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. We've had a good week, folks, and here's hoping that next week will be even better. You have a safe weekend, and we will see you next time.